Welcome back. Markets are higher ahead of the open this morning. Investors are bracing for the biggest week of third quarter earnings yet this week. Dow Industrial's up better than 90 points ahead of all of these earnings coming out, 1/3%. We got big names like Amazon, Microsoft, Google parent, Alphabet all set to report. Those are NASDAQ companies, and the NASDAQ is up this morning. As you see, all the numbers coming out from a number of companies, Caterpillar, McDonald's, also market movers there. Joining us now to talk more about that is Wells Fargo Senior Global Equity Strategist, Scott Wren. Scott, it's good to see you. Thank you so much for joining us this morning. What are your expectations for earnings and heading into the earnings season? Is it priced into markets?
Well, Maria, good morning. And I think what really people want to know, what the market wants to know, is we know these earnings are going to be good overall, 20%, maybe a little bit more than that. But I think what the market really wants to hear about is what's going to happen in 2019, because clearly earnings growth in 2019 is going to be nowhere near what it is this year. And then, of course, you know, what's the cost? What are these tariffs doing to costs? Is there wage pressure? Anything that affects margins? So I think that's what's really more important than the absolute results, because, you know, we know they're going to be good results.
Scott, it's pretty interesting what's happening in the market right now, and that's obviously the dislocation seemed to be about one of those costs, and that's the rising cost of capital, right, going up. But to me, it doesn't seem like the Fed is really, you know, making a mistake here, given that inflation's up about 2.5% over the last 12 months, but their Fed funds rate is still below that, so it's negative on real terms. Where do you see the Fed going next year, and where do you see rates going, and how is that going to impact where the market goes for the next year? Because it seems if we're only up 4% so far this year, could we have another year next year where it's only up a couple percent?
Well, I think, you know, as far as our fixed income group, they're looking for a hike in December, which I think the Fed is certainly directing the market toward that. They're also looking for 3 more next year. So basically between now and the end of 2019, looking for 4 more hikes. From an equity strategy point of view, you know, we think that you know, that's really, you're kind of at the red line, and I think the market is going to be very sensitive to any hint or conversation or enthusiasm out of Jay Powell that you know, hey, we might increase the pace here, which I think the market would not take very well. Now, as far as the S&P 500 right now, at least based on our analysis, stocks are pretty close to fair value. Our year-end target's been 28 to 2,900. We're just a touch below there. And I think probably over the course of the next 12 months or so, you could see the S&P 500, let's call it 8% higher than where we are now. So even though we think stocks are pretty fairly valued right now, still think there's some upside here, still think the bull market is not over. We still want to lean towards those sectors that are sensitive to a continuation of the recovery. We don't want our clients hiding right now.
Scott, it's Dagan McDowell. What do you make of the Wall Street Journal highlights slowing sales growth and how that's a major headwind for the markets, noting that third quarter sales are expected to be up 7.3% from the same period last year. This is for the S&P 500, but that is the lowest rate for the S&P in 4 quarters. And Lindsay Bell has been on this program and voiced her concerns as well about that.
You know, Dagan, last quarter, I have to say, we were looking for about, in the second quarter, we were looking for about 8% growth, and it came in close to 10. So our number for this third quarter reporting season was 8%, and we're a touch below that. So, you know, I would consider really anything, you know, at this point in the cycle, anything, you know, you're 6 to 8 to maybe 6 to 9% earnings growth, or revenue growth, rather. I think that's good, and I think next year you'll probably see something at the lower end of that range, but I think that's what the market expects. It's probably priced in, and really, you know, 7 or 8% earnings growth in the third quarter, I don't really think that's going to bother investors.
So you would put new money to work right here then, Scott?
Oh, absolutely, Maria. You know, we're going to open this morning basically sitting right on the 200-day moving average, and we closed below it a time or two over the last couple of weeks. But right now, I think you're at a point where if you have money on the sidelines, you need to start legging in. And if we trade a little bit lower here, you should continue to do that. So if you have a certain amount of money, you know, at these levels, put a third of it in. And if we go a little bit lower, step in with another third. Because if you think, as I do, that a trade war is unlikely, that we're going to continue to see decent international growth That's based on what our economists are looking at. We're going to see decent growth here in the U.S. Then the forward fundamentals look pretty good, and we want our clients stepping in here and getting exposure if they have cash on the sidelines.
All right, Scott, we'll be watching. Thanks so much. Scott Wren joining us there from Wells Fargo.